What happens when a gold miner finally finishes building its flagship mines, sells off its non-core assets, and suddenly finds itself staring down the barrel of $5,000 gold? Yesterday, Equinox Gold dropped its 2025 annual report and 2026 forward guidance. The headline? A record 922,000 ounces of gold produced, and a massive ounces of gold produced, and a massive $1.1 billion wiped off their debt ledger. Welcome back to Intrinsic Insights, where we cut through the Wall Street noise and look at the resource sector like owners, not just traders. Today, we are putting Equinox Gold's latest numbers through the Rick Rule ringer. No fluff, no hype. We're looking at management, the all-in sustaining costs, and running a stress test on their net asset value across bear, base, current, and bull markets. Let's dig in. Rick Rule always says you start with the people. A bad management team can destroy a great deposit, but a great team can navigate a crisis. Going into 2025, Equinox had a balance sheet that made a lot of contrarian investors nervous. Roughly $1.4 billion in net debt. But CEO Darren Hall and Chairman Ross Beatty did exactly what they promised. They finished building Greenstone in Ontario, they brought Valentine online in Newfoundland, and in early 2026, they ruthlessly optimized the portfolio by selling their Brazil operations for over $1 billion. Today, net debt is sitting at a microscopic $75 million. They completely de-risked the balance sheet right as gold prices went parabolic. They even instituted an inaugural dividend of 1.5 cents a quarter. That is textbook capital allocation. Now let's talk about the margin of safety. In mining, your margin of safety isn't just your cash balance, it's the delta between your all-in sustaining cost and the price of gold. Equinox's forward guidance for 2026 projects, 700,000 to 800,000 ounces of gold production at an AISC of 1775 to 1875 per ounce. To figure out exactly how wide that margin of safety is, we need to stress test Equinox's cash flows under 4 scenarios: the bear, the Q4 baseline, the current market, and the bull. The bear case, $2,500 gold. Let's say we get a severe deflationary shock. Gold gets cut in half from today's prices. At $2,500 an ounce, Equinox is still above its 1875 AISC. The operating margins shrink, and they would have to slash their growth budget. However, because they just wiped out that $1.1 billion in debt, they don't go bankrupt. They survive to see the next cycle. That margin of safety is why that debt payoff was so crucial. The Q4 baseline case, $4,060 gold. This is the realized price Equinox reported for the Q4 of 2025. It is critical to understand the difference between realized price and spot price here. The realized price of $4,060 is the actual, literal average cash price the company collected for the physical ounces they mined, refined, and delivered to buyers over those 3 months. At this baseline, a $2,185 margin yields roughly $1.7 billion in operating margin. The current spot case, $5,000 gold. This is the spot price, the live, fluctuating price of paper gold contracts trading on the global exchanges today, right now in February 2026. While the realized price looks backward at what was banked in Q4, the $5,000 spot price is the current reality. If Equinox realizes today's $5,000 spot price across 800,000 ounces, their margins blow out to over $3,100 an ounce. You're looking at nearly $2.5 billion in annual operating margin. They easily wipe out their remaining debt in weeks and have a mountain of free cash flow for buybacks and dividend hikes. The bull case, $6,500 gold. If fiat debasement accelerates and geopolitical tensions push gold to $6,500, Equinox becomes a cash printing machine. Operating margins would exceed $3.6 billion annually. In this scenario, the optionality of their pipeline, that extra 500,000 ounces of organic growth they have waiting in the wings, gets dramatically repriced by the market. So, what is the market missing? Equinox traded low-margin ounces in Brazil for high-margin, Tier 1 jurisdiction ounces in Canada. They traded massive debt for absolute financial flexibility. They have transformed from a high-risk builder into a de-risked cash-flowing operator with a massive margin of safety. What do you think of Equinox Gold's turnaround? Are they finally out of the penalty box, or is the market right to be cautious? Let me know in the comments below. If you want more deep dive, contrarian analysis, hit the like button, subscribe to Intrinsic Insights, and I'll see you in the next one.